Are you ready for the next stock market decline? Back in 2007, we voiced concern over the stock market's big run-up that lasted about 5 years without a major correction. While we certainly couldn't have predicted the extent to which the markets would fall, there were signs of the old irrational exuberance. When individual investors start talking about becoming more aggressive in their portfolios, this can be a sign that the markets may be in for a downturn. Well, guess what? Individuals are now talking about getting more aggressive in their portfolios. On top of that, consider that the Fed is pumping approximately $85 billion a month into the money supply as part of the quantitative easing program known as QE2. This money has had to find a place, and as opposed to finding its way into savings and checking accounts paying about 0.25%, it's found its way into the stock market with hopes of better yields. Eventually, the government will stop adding these huge amounts into the system, and there will be less money moving into the market, which could mean less stock market growth. While we don't expect anything as bad as the financial markets collapse and Great Recession, which started in September of 2007 and ended in March of 2009 with the S&P 500 losing in excess of 50% of its value, we do have concerns about the huge run-up that has occurred from March of 2009 to now, and the trillions of dollars that the government has pushed into the system without a major stock market pullback or correction. While we are optimistic on the U.S. economy and stock market over the long term, we know that it is a possibility to have pullbacks or corrections before the markets can continue to move higher. Think of it as a runner who will occasionally need to stop and take a breath before continuing further along his path. So, what should you do to help protect yourself if the market were to be in a decline? The bottom line is you must manage your risk. While none of us can control the stock market, we can attempt to manage our risk. Unfortunately, this is something most people don't do. However, at RPG Life Transition Specialists, when it comes to managing our clients' wealth, this is one of our core focuses. We become their risk managers and build portfolios that attempt to participate in rising markets while potentially minimizing losses in falling markets. This allows us to truly stay the course and not worry about having to time the markets when they become overly volatile. So how much risk should I take? What returns do I need? These are questions that virtually everyone we've come across cannot answer, but they are absolutely vital to know before you decide on how to invest your money. It seems as if many people jump on a ride because the media or someone else told them to, only to find that they are now on a roller coaster ride with twists, turns, and loops they never expected. So ultimately, they get so nauseous that they need to get off the ride, and then they're faced with the challenge of determining when to get back on the next ride. So some of the worst advice people have become brainwashed to accept is to stay the course. This is poor advice because quite often the party giving that advice has no idea of the course their listeners are even on. What type of ride are you on? We highly recommend that you become educated on what you currently have and understand the quality, risk, and fees associated with your entire portfolio, including your 401k plans at work. A qualified professional should be able to help you set long-term goals and identify how much you need to save, as well as the rates of return required to help you get successfully to your goals. Once you know the rate of return that you require, your portfolio should then be designed to manage your risk and shoot for those returns with as little downside risk as possible. Remember, there are many things in life we cannot control, and the stock market is one of them. We encourage you to focus your time and energy on the things that you can control. Becoming educated, managing your risk, and setting your course are among them.